Here's the first thing most people don't realize. There's not one price for silver. There are two completely different worlds, and most investors spend their entire lives looking at only one of them. World 1, paper silver. This is the world you see on screens. Futures contracts, ETFs, options, derivatives. Trillions of dollars move through the system at the speed of light. Numbers change every second. Charts flash red and green. But here's the uncomfortable truth. Most of this silver does not exist. It's a promise, a contract, a bet on a future price. More than 90% of paper silver trades never result in a single ounce being delivered. They are settled in cash, rolled forward, closed digitally. This system works beautifully as long as confidence holds. World 2, physical silver. This world doesn't move at the speed of light. It moves by mine, refinery, ship, and truck. This is the silver that comes out of the ground, gets refined to industrial purity, sits in vaults, gets consumed inside solar panels, electronics, EVs, and data centers. This silver is not traded, it's used. And once it's used, it's gone. Normally, these two worlds stay connected through something called arbitrage. If silver is cheap in one place and expensive in another, traders step in, move the metal, and prices stay aligned. That's how the system is supposed to work. But now I want you to remember what happened in late 2025. Paper silver prices dropped sharply in parts of the Western market. Red candles, panic headlines, crash thumbnails everywhere. Yet at the exact same time, the price to actually get physical silver in other parts of the world stayed stubbornly high. The link stretched and almost snapped. People screamed, "Arbitrage is broken." But here's the truth. This wasn't a conspiracy. This wasn't manipulation in the cartoon sense. This was the system working exactly as designed and revealing its flaw. Because that disconnect between paper promises and physical reality is not a bug. It's the first structural crack. And silver finds it every single time. But here's the question that matters. Why silver? Why not oil? Why not copper? Why not gold? Why does silver keep becoming the pressure point where financial systems reveal stress? To answer that, you have to understand silver's identity crisis. Because silver is trapped between two masters. And that tension is what breaks systems. To understand why silver keeps breaking systems, you have to confront something most investors never do. Silver does not know what it is supposed to be. It is trapped in an identity crisis. For thousands of years, silver was money, not symbolic money, not abstract money, real money. Empires rose and fell on silver coinage. Trade routes were built on it. Taxes were collected in it. Wages were paid in it. When people didn't trust rulers, they trusted silver. That memory is not philosophical. It's cultural. It is hardwired into how humans think about value. That's why, even today, when confidence in currencies weakens, people instinctively look at silver the same way they look at gold, a store of value, a hedge, a form of protection. That is silver as money. But here's the problem. The modern world didn't stop there. In the 21st century, silver became something else entirely. It became infrastructure. Silver is the most electrically conductive metal on Earth. Not one of the best, the best. There is no substitute that performs the same way in high-efficiency systems. That's why silver is everywhere you don't see it. Inside solar panels, inside electric vehicles, inside smartphones, inside data centers, inside medical equipment, inside advanced defense systems. This silver is not invested in. It is consumed. And once it is consumed, it does not come back. That is silver as metal. Here is the paradox. Financial markets treat silver like gold. Industry treats silver like oil. One side wants to store it. The other side needs to burn it. And both sides are growing at the same time. No other asset lives in this contradiction. Gold is almost entirely monetary. Copper is almost entirely industrial. Oil is consumed, but not stored as wealth. Silver sits right in the middle. And systems do not like assets that live in the middle. This is where traditional analysis collapses. If you value silver like a currency, you miss industrial demand. If you value silver like a commodity, you miss monetary behavior. So analysts keep getting surprised. They ask, why is silver so volatile? Why does it spike and crash? Why doesn't it behave rationally? It is behaving rationally, just not inside a framework designed for simpler assets. When financial stress appears, money demand increases. People buy silver as protection. When technological growth accelerates, industrial demand increases. Factories buy silver to keep production running. Those two forces don't coordinate. They collide. And when they collide inside a system that is still priced mostly through paper contracts, pressure builds. That pressure has to go somewhere. So it goes into volatility. This is why silver never moves quietly. It does not grind higher like bonds. It does not trend smoothly like equities. It surges, it collapses, it whipsaws. And every time it does, people declare a new narrative. This time it's manipulation. This time it's speculation. This time it's different. But the pattern never changes, because the structure never changes. This identity crisis also explains why silver constantly confuses retail investors. When price rises, the narrative becomes scarcity and protection. When price falls, the narrative becomes excess supply and failure. Both narratives are incomplete, because silver is being pulled by two systems that do not communicate: the financial system and the industrial system. And neither one is fully in control. This is why silver acts like a stress test. When the financial system is stable, silver behaves like an industrial metal. When the financial system becomes unstable, silver behaves like money. And when both pressures rise at the same time, as they are now, something has to give. But there is another layer to this story, because even this paradox alone does not fully explain why silver keeps exposing cracks. To see the full picture, you have to look backward, not at prices, but at cycles, because silver has done this before, many times, and every time the same pattern repeats. To understand where silver is going, you have to stop looking at charts and start looking at patterns, because silver doesn't move randomly, it moves in cycles. And those cycles are older than modern markets. Let's rewind, not to predict the future, but to expose the machine. 1980. The Hunt brothers. This is where most people start the story. Two wealthy oil billionaires attempted to corner the silver market. They accumulated physical metal. They used leverage. They believed scarcity would force price higher. And it did. Silver exploded. Headlines scream manipulation. Politicians panicked. Rules were changed. Margin requirements were raised. Trading was restricted. Liquidity vanished. Silver collapsed. And history recorded it as a warning. But that is not the real lesson. The real lesson is this: silver did not break because demand vanished. It broke because leverage exceeded tolerance. The system protected itself. 2011, the currency collapse narrative. Fast forward. Quantitative easing, zero interest rates, fear of dollar debasement. Once again, silver became money. Investors piled in. ETFs expanded. Paper demand exploded. Silver surged toward $50. And once again, paper markets amplified the move. Then reality returned. Margin hikes, liquidity withdrawal, confidence reversed. Silver crashed. Again, same outcome. Different decade. Here's what matters. In both cases, the narratives were different. The players were different. The macro environment was different. But the structure was identical. Every silver cycle follows the same steps. 1. A structural stress appears: currency risk, supply tightness, or industrial demand. 2. A compelling narrative forms: scarcity, collapse, end of the system. 3. Paper markets amplify the move. Leverage increases. ETFs expand. Derivatives multiply. 4. Price disconnects from physical reality. Volatility spikes. Arbitrage stretches. 5. The system reasserts control. Rules change. Liquidity is withdrawn. 6. Confidence collapses. Price crashes. Narrative dies. 7. Memory resets. Silver is ignored until the next cycle. This is not manipulation. This is system behavior. Silver does not break markets. Markets break themselves around silver. Because silver exposes contradictions, other assets can hide. This is why silver's history looks chaotic. It's not because silver is unstable. It's because the system trying to price it is. Paper markets want predictability. Silver delivers tension. Paper markets want smooth curves. Silver delivers spikes. And every time pressure builds too far, the system snaps back. Here's the mistake most people make. They assume history repeats because people don't learn. That's only half true. History repeats because structures don't change. Paper pricing still dominates discovery. Leverage still expands in good times. Liquidity still vanishes under stress. Silver just keeps revealing the same flaw. And here's the critical insight. Silver does not top because it is too expensive. It tops because confidence outruns structure. When price rises faster than physical flow, the system pushes back. That pushback looks like collapse, but it is actually containment. This is why calling every drop a failure misses the point. Crashes in silver are not endings. They are resets. They clear leverage. They erase memory. They restore control until pressure builds again. Which brings us to now. Because this cycle is familiar, but it is not identical. There's one difference this time that did not exist before, and it changes everything. Up until now, silver's story has always ended the same way. Pressure builds, price spikes, leverage explodes. The paper system pulls the emergency brake. Reset, forget, repeat. That cycle worked for decades because control was centralized. Paper markets decided price. Physical markets adjusted later. But that hierarchy is changing. And that is the difference this time. In every previous cycle, the paper market had one ultimate advantage. Metal was available somewhere. If prices spiked too fast, inventory could be sourced. If arbitrage widened, metal could move. If pressure rose, supply eventually responded. That safety valve mattered, because as long as metal could be mobilized, paper could maintain authority. That assumption is now under stress. Let's talk about where control actually lives. Not in trading volume, not in futures open interest, not in financial television. Control lives in bottlenecks, and silver's bottleneck is no longer mining, it's processing. Most people still believe silver supply is determined by how much is dug out of the ground. That's outdated thinking. Silver is primarily a byproduct metal. It comes from copper, zinc, and lead mining. Raising the silver price does not magically create new supply. But even more important than mining is this. Raw silver is useless to modern industry. It must be refined, processed, manufactured to specification, and that infrastructure is concentrated. Over the past 2 decades, China quietly built dominance in silver processing. Not mining dominance, refining dominance. Silver from Latin America, Africa, and Asia often passes through Chinese refineries before it reaches global markets. That gave China leverage, quietly. And leverage does not need headlines. It only needs the ability to say, not yet. Now layer in industrial demand. This is the part most financial models underestimate. Silver is no longer just a hedge, it is infrastructure. Solar panels, electric vehicles, electronics, power grids, data centers. These systems do not speculate. They consume, and consumption does not reverse easily. Factories don't shut down because price went up. They shut down because metal is unavailable. That flips the power dynamic. Here's the key shift. In previous cycles, when price rose too fast, industrial buyers stepped back. They waited. This time, waiting costs more than buying. Because supply chains are tighter, just-in-time inventory is fragile, and geopolitical risk is rising. That makes availability more important than price. Now combine that with policy, export controls, licensing systems, domestic prioritization. These are not bans, they are filters. They don't stop supply, they redirect it. And redirection breaks arbitrage. Remember the old stabilizer, buy cheap here, sell expensive there, prices converge. That only works if metal can move freely. When movement is constrained, 2 prices can coexist, paper price, physical price. That is not manipulation, that is fragmentation. This is why recent stress feels different. In past cycles, paper markets could always reassert control because physical supply eventually responded. This time, physical markets are responding first, and paper is reacting. That is a reversal. This does not mean silver goes vertical forever. It means the reset mechanism is weaker. Leverage can still be flushed, confidence can still be shaken, but the floor keeps rising. Because the industrial base does not reset with sentiment, factories don't forget, infrastructure doesn't deleverage. This is why volatility is increasing, not decreasing. The system is trying to price something that now serves 2 masters, finance and function. And those 2 move at different speeds. This is not the end of the cycle, but it may be the end of the old rhythm, not spike and collapse, but pressure and repricing, slower, messier, more uncomfortable, which is why narratives feel louder. The system always gets loud when control is slipping. At this point, the story should feel familiar, not because silver is repetitive, but because systems are. Every complex financial system eventually reveals stress at its weakest junction. For global finance, that junction has always been trust. Trust that promises can be honored. Trust that delivery can be delayed. Trust that liquidity will always appear when needed. Silver tests that trust more consistently than almost any other asset, not because it is dramatic, but because it must be real. Silver cannot be rolled forward forever. It must be mined, refined, delivered, consumed. That single fact makes it incompatible with systems built on infinite leverage. And when incompatibility appears, markets don't fail loudly. They signal quietly. That's what silver does. It doesn't announce collapse. It exposes strain, small gaps, delayed shipments, rising premiums, inventory withdrawals. Individually, these seem insignificant. Together, they form a pattern. This is why silver keeps producing cycles of obsession and neglect. During calm periods, it is ignored. During stress, it becomes the messenger. Then the system stabilizes, confidence returns, and attention fades again. Not because the issue was resolved, but because pressure was deferred. What feels different now is not price. It's persistence. The stress no longer resets cleanly. The gaps return faster. The volatility remains elevated. The industrial base grows heavier. The system is carrying more weight with less flexibility. This does not mean silver is the answer. That thinking misses the point. Silver is not a solution. It is a diagnostic tool. It shows where assumptions break. So when you see headlines shouting, "Silver is breaking the system," the more accurate translation is, the system is encountering its own limits. Silver just happens to be where that limit becomes visible first. This is why we don't talk about price targets here. Because numbers change, narratives shift, but structure remains. If you understand. the paper versus physical divide, the money versus metal paradox, the role of bottlenecks, the historical cycle of stress and reset. Then headlines lose their power over you. You stop reacting. You start observing. That is the real edge, not predicting the next spike, not chasing fear or excitement, but recognizing what kind of market you're in. A confidence market or a constraint market. Silver has entered a constraint phase, not permanently, but meaningfully. And constraint markets behave differently. They move unevenly. They resist simplification. They punish emotional decisions. This doesn't require belief. It requires perspective. Because systems don't announce transitions. They reveal them slowly, through friction. Silver is friction. At AG Currency, that's what we track. Not hype, not targets. Structure. Because when you understand structure, you don't need certainty, you need clarity. Thanks for watching.